Welcome back to Wall Street Week. We're talking now with Northwestern Mutual CEO John Schlifske. John, moving from the UK to the US, we've got a really interesting political situation here. Your business hates uncertainty. It's pretty uncertain right now. How do you read things?
Well, you know, from a presidential perspective, I don't think it really matters. With all due respect, whether it's Trump or Hillary, they're only going to be in office 4 or 8 years. We invest for 30, 40, 50-year cycles. So, frankly, from a political perspective, I think it makes better reality television than it does in terms of what you should do from an investment perspective. Ultimately, I think the U.S. is a great place to invest. We think long-term the prospects are good. And so, from our perspective, it's don't change anything. Just stick with what you know.
So, John, there's been a number of investors on our show we've asked the question to, and they all say the same thing. Doesn't matter who the next president is. Here's what the markets look like. Do you think we're that disconnected from the political situation and the tax and regulatory potential policies of the future administration?
No, I don't think we're that disconnected, and I frankly think whoever gets in is going to have a better growth agenda. I think we've had 8 years of very anemic growth, and it's starting to show up in sort of personal incomes and the way people feel about the country, and I think we got to get back on a growth trajectory. But ultimately, you know, the politicians can only do so much. We have a fairly balanced political scene in Washington right now between the Democrats and the Republicans, and so I think it's going to be more of the same, sort of just middle of the road kind of stuff.
Interesting point,
though. No matter who gets in.
No matter who gets in.
Interesting point, though, the way you're thinking about investing. You said it's 4 years or 8 years, and we're just on the beginning of this process.
Right.
And you're looking way past that already, thinking about what the business will be. When Bob Nardelli joined us about a month ago, he talked about this idea of trying to come up with some way to bring back all the money overseas with a change in the corporate tax policy, corporate tax rate, and it would have maybe even like a 1% impact positive to GDP. Does that make sense to you?
Yeah, I think, you know, I spent a lot of time on Capitol Hill, and I think that both parties are really interested in reforming the corporate tax situation. I mean, it's crazy what's going on now, and I do think that if they find a way to make it more pro-growth, I think that will have a huge positive impact on the economy here.
So they haven't been able to do that, and they all want to do that. They've all talked about repatriating the capital, reforming the tax rates, creating a more pro-growth environment, but they just cannot seem to do it. So when you're on Capitol Hill and you ask them that question, what do they say?
I think what you see is just a difference in opinion. One side wants to sort of lower rates and have a more pro-growth agenda, and the other side wants to make sure that there's a fair redistribution of wealth and things like that. And right now, it's very difficult to find common ground in those kind of situations. Frankly, from our perspective, I like to say we're a company for all economic seasons. We have to thrive regardless of which party's in power, which sort of agenda is going on, and so I don't pay too much attention to that, and we just try to live within the rules that we're given and do as best we can.
Any sectors that you're super bullish on right now?
Well, given our sort of low growth, low rate environment, we're very positive on corporate fixed income. I think high yield's attractive right now. We're investing in real estate and mortgages.
Structured credit as well? Like
we don't do a lot of structured credit, but just the higher quality end of the high yield market, strong double Bs, double Bs and strong single Bs. I wouldn't get down in the triple C category, but there seems to be some good value there. So I think from where you can get good yields without taking an enormous amount of risk, that's kind of where we see the play right now.
And what about the opportunities outside of the United States? I know that you're focused on this country and you're focused on your clients in this country, but as you talked about Japan, you've got interest rates around the world down, low, and negative. Do you look to try to take advantage of any opportunities outside of the country?
Sure. 20% of our investment portfolio is invested globally, in Europe and in Asia and South America. You know, the big thing that I think we're focused on now is 100% of our foreign investments are hedged. We're very...
Well, that was the second part of my question. Given what's happened with the dollar this week, are you trying to take out the currency? Are you just trying to get total return on an absolute basis?
We think the dollar is going to continue to strengthen, and so we do not want to have a lot of foreign currency risk in our portfolio right now. So we're 100% hedged from a currency perspective, and we're really just investing in companies that we think can grow globally. I actually think the separation vote in the UK could be an opportunity for some private equity investment in Europe right now, because things are cheaper than they were.
But if you had to name 2 reasons why the dollar was going to strengthen, what are they?
I think the 2 big reasons are We have positive rates. I just read in the last day or two, I think there's $12 trillion in bonds globally that are in negative yielding securities.
Right.
So we have a positive yield curve still, a positive yield even at the short end. And then the second thing is safety. People know the United States is going to stand behind its debt, and it's just the one last place where you can get certainty of principle.
Yep.
We really appreciate your time. We want to thank John Schlifske for joining us today on Wall Street Week. We got more ahead. Stay with us, please.